Stop looking at the spot price. Seriously, turn it off. It is a work of fiction. It is a hallucination generated by a broken algorithm. While you are staring at red and green candles on a screen, the real world just ran out of metal. Yesterday at 3:45 p.m. Eastern, something historic happened. Something that should be on the front page of every financial newspaper but isn't. The United States Mint website went dark. I don't mean it crashed, I mean they scrubbed it. If you went to buy a Silver Eagle, the standard unit of American wealth protection, the Buy Now button wasn't just grayed out. It was gone, deleted. The sovereign mint of the world's reserve currency turned into a digital ghost town. They issued no press release. No Treasury Secretary came out to explain. Just a leaked email to distributors whispering about market volatility. Let me translate that for you. Market volatility is bureaucrat speak for we have no silver and we can't afford to buy any. This is the moment the paper market died. Right now, your screen might tell you silver is $90. Bloomberg calls it a spike. I call it a lie. Try to buy silver for $90 right now. Go ahead, I dare you. Call your local dealer. Check the online bullion sites. You know what you're going to find? Premiums that make your eyes water. We are seeing generic rounds trading at 1.5 times spot. That puts the real price of silver, the price to actually hold it in your hand, closer to $135 an ounce. There is a $45 gap between the lie on the screen and the truth on the street. This is a phenomenon called backwardation, and it is the single most terrifying signal a commodities market can flash. Normally, stuff is more expensive in the future because you have to pay to store it. But right now, the market is so desperate for metal today, this very second, that people are paying massive premiums just to cut the line. They don't want a futures contract for delivery in June. They know that by June, the vaults might be empty. They want the metal now. The US Mint is caught in a vice. They are required by law to sell to the public, but they are also bound by physics. They cannot source raw silver blanks at the fake paper price of $90 when the industrial miners and refiners are demanding $120. So instead of raising the price and admitting that the dollar has collapsed against silver, they just shut down. They pulled the plug. They are hiding under the desk, hoping you won't notice. But we noticed. And we aren't the only ones. The arbitrage bots noticed too. While New York plays games, Shanghai is draining the world dry. We are seeing a massive flow of physical metal moving from west to east. China just slapped new export controls on refined silver as of January the 1st. They are locking the doors. The metal goes into China and it doesn't come out. The liquidity vacuum we talked about last week is here. It is not a theory anymore. When the US Mint stops selling, it removes the psychological anchor for the entire market. It tells every hedge fund, every pension manager, and every stacker that the supply chain has snapped. So what happens next? London, the LBMA. They are the next domino. If the US Mint can't source retail product, how long until the London vaults admit they can't cover their wholesale obligations? We are hearing whispers of cash settlement, forcing you to take worthless paper dollars instead of the metal you paid for. In this breakdown, we are going to dissect the anatomy of this squeeze. We are going to show you why the $90 price tag is just a placeholder for sold out. The screen is lying to you. The mint is hiding from you. And the only truth left is the weight in your hand. Welcome to the shortage. To understand why you can't buy a Silver Eagle today, you have to understand the engine that drives this market. And right now, that engine is blowing smoke. We need to talk about the mechanism of the squeeze because the mainstream media is too incompetent to explain it to you. It starts with a concept called backwardation. I know it sounds like boring financial jargon, but stick with me because this is the smoking gun. In a normal world, buying something for future delivery should cost more than buying it today. You have storage fees, you have insurance, you have the cost of money. That is called contango. That is how the market works 99% of the time. But right now we are in the 1%. We are in backwardation. The price to get silver in your hand today is radically higher than the price for a futures contract in 3 months. Why? Because the market is terrified that in 3 months there won't be any silver left. Think of it like buying a life jacket on a sinking ship. Do you want the life jacket now for $1,000? Or do you want a contract for a life jacket delivered next week for $50? You pay the $1,000. You pay it gladly. That is what is happening in the physical market. The premium you see, the 40% or 50% markups over spot, that is the fear premium. That is the market screaming for immediate possession. And here is the accelerator, China. For the last month, we have watched a massive gap open up between the West and the East. Silver in Shanghai has been trading $5 to $10 higher than in New York. This is an open arbitrage window. It is free money for anyone with a shipping container. The arbitrage bots, those high-frequency algorithms that run Wall Street, they smelled this blood in the water. They have been relentlessly buying every available ounce in New York and London to ship it to Shanghai to capture that spread. They are draining the West dry. They are sucking the inventory out of the COMEX and the LBMA vaults and sending it on a one-way trip to Asia. And I mean one way. As of January the 1st, China implemented strict new export controls on refined silver. They know exactly what they're doing. They are hoarding strategic resources while the West plays games with paper derivatives. The metal checks into China, but it doesn't check out. This creates a feedback loop from hell for the bullion banks. The banks usually control the price by selling paper shorts. They flood the market with digital silver to scare you into selling. But you can't short a market that is in backwardation. If you sell short today, you have to deliver metal tomorrow. And if you don't have the metal, you are dead. You get squeezed. We saw this yesterday. The price didn't just go up. It teleported. It skipped from $73 to $75 to $78 in a heartbeat. That happens when there are zero sellers. The order book was a ghost town. The banks pulled their asks because they were too scared to sell valuable metal for worthless paper. This is the mechanism of a collapse. Not a collapse of value, but a collapse of the delivery system. The US Mint didn't close because they wanted to take a holiday. They closed because the mechanism broke. They can't compete with the Shanghai Magnet. They can't compete with the industrial panic buyers who are paying any price to keep their factories running. So when you look at that frozen buy button, realize what you are seeing. You are seeing the gears of the Western financial system grinding to a halt. The paper price is a lie. The mechanism is broken. And the only thing that matters now is who actually holds the metal. So the monetary system is shaking. Gold is flying. The banks are covering. But what about the factories? What about the people who actually need silver to build products? We are leaving the trading pits and going to the industrial front line, because that is where the war is being lost. If you are a solar panel manufacturer and the price of your raw material just went up 8% in a day, you are terrified. You're about to panic buy inventory before it goes up another 8% tomorrow. This is the concept of inelastic demand, and it is the reason why this squeeze is unstoppable. Let me explain. Imagine you are building a Tesla or a Patriot missile. Silver is a tiny fraction of the total cost, maybe $50 per car. If silver goes to $100 per ounce, the cost of the car goes up by another $50. Does that matter on a $5,000 vehicle? No. It is a rounding error. You will pay it. You will pay $200. You will pay $500. Because if you don't have that ounce of silver, you can't ship the car. You lose the entire $5,000 revenue because you tried to save money on a $50 part. Industrial buyers are not price sensitive. They are availability sensitive. When they see the US Mint run out of silver, they don't think, oh, the price is too high. They think, oh no, there is a shortage. I need to buy everything I can get my hands on right now. We are witnessing a massive shift in corporate strategy. For 30 years, businesses ran on just-in-time delivery. They kept zero inventory. They trusted the supply chain. That era is over. Today, they are switching to just-in-case hoarding. They are draining the wholesale market to build massive stockpiles because they are terrified of being caught without metal. This creates a self-fulfilling prophecy. The more they hoard, the scarcer the metal becomes. The scarcer it becomes, the higher the price goes. And the higher the price goes, the more they panic and hoard. It is a feedback loop that destroys the short sellers. We are seeing reports of industrial users doubling their orders for 2026. They are trying to lock in supply contracts for years in advance. But the miners are saying no. The miners know the price is going higher, so they are refusing to lock in prices at these levels. This forces the industry into the spot market where they have to compete with you and me and the arbitrage bots. Think about the timing. The world is trying to transition to green energy. Solar demand is exploding. EV demand is growing. The AI revolution requires massive amounts of computing power and chips which all use silver. We have a demand shock meeting a supply cliff. The mines are empty. The grades are falling. We haven't found a major new silver deposit in a decade. And right in the middle of this perfect storm, the inventory vanishes. This is why $78 silver is not a top. It is a floor. The industry will defend this price because they have to. They cannot function without the metal. The paper market can play games with leverage and margins, but eventually a factory manager somewhere needs a physical bar of silver to put into a furnace. And right now that factory manager is sweating. The industrial panic is the rocket fuel that will take us to triple digits. They are buying at any price. Are you? The shorts are dead. The East is leading. But silver is not alone in this move. There is another signal flashing red on the dashboard. A signal that tells us this isn't just about a shortage of metal. It is about the stability of the global financial system. We need to talk about gold. Gold just made a move that is statistically rarer than the silver spike. Gold is up $135. That is 3% in a single day. For the world's largest reserve asset that is an earthquake, it is a tsunami. You have to understand the scale here. Gold is a $15 trillion asset class. It moves like a glacier usually, but yesterday it moved like a meme stock. A 3% move in gold is the equivalent of the Dow Jones moving 1,500 points in a day. It is a black swan event. This does not happen during normal trading. It happens during invasions. It happens during bank collapses. It happens when the smart money smells fear. The central banks and the sovereign wealth funds are fleeing the dollar. They are fleeing the bond market. And they are piling into the only asset with no counterparty risk. This validates the silver rally. Silver is not going up because of a Reddit squeeze. It is going up because the entire monetary order is being repriced. Silver is simply drafting behind the king. And when the king runs, the prince sprints. This brings us to the concept of high beta. In finance, beta measures how much an asset moves relative to a benchmark. Silver is historically gold on steroids. It has a beta of roughly 2 or 3 against gold. If gold goes up 1%, silver goes up 3%. Today, gold went up 3%. Silver went up 8%. The math holds perfectly. This correlation is your safety net. If silver was up 8% but gold was flat, I would tell you to be careful. That would look like a trap. But because gold is leading the charge with a historic move, silver is justified. It is catching up. Now let's look at the magic number, the gold to silver ratio. At the start of the week, it was near 60. Today, with gold at 44.67 and silver at 78, the ratio has dropped to roughly 56. We are compressing. This means silver is outperforming gold. Historically, during the mania phase of a bull market, this ratio collapses. It goes to 40, then 30, then 15. We are still at 56. This tells us that despite the 8% rally, silver is still undervalued relative to gold. It has not even reached its historical average valuation yet. Let's do the math. If the ratio returns to the 2011 lows of 30-1 and gold stays right here, silver would be $148. That is why the algorithms keep buying. They are playing the ratio trade. They sell expensive gold and buy cheap silver to close the gap. As long as gold remains strong, the floor under silver rises mathematically. Gold is the shield. Silver is the sword. We also have to look at the macro calendar. The US debt ceiling is approaching. The Treasury is running out of cash. The bond market is getting nervous. A 3% move in gold is a vote of no confidence in the government. The market is pricing in fiscal dominance. This is the endgame where they print money to pay the bills. When that kicks in, fiat currency loses value rapidly. Hard assets re-rate to infinity against the dying currency. We are watching the market realize that the debt spiral is terminal. There is no way out except inflation. And silver is the poor man's safe haven. When gold gets too expensive for the average investor at $4,400, they turn to silver. At $78, silver still looks affordable. This substitution effect drives silver higher as gold becomes a luxury asset. So here is the verdict on the valuation. We are not in a bubble, we are in a correction to reality. The paper price was a lie. The ratio was a lie. Now the truth is coming out. Do not let the volatility shake you out. We are still cheap. We have watched the short sellers burn. We have watched gold scream. But financial markets are just a reflection of the real world. So let's look at the dealer markets, because that is where the rubber meets the road. If you think it is hard to buy a contract on the COMEX, try buying a monster box of Eagles today. The paper price is $78. The physical price is sold out. This is a nightmare for bullion dealers. Imagine you are a dealer. You own 1,000 ounces of silver that you bought for $70. Suddenly the spot price rips to $78. You should be happy, right? You made a profit, but you have a massive problem. If you sell that silver to a customer today for $79, you have to replace it. You have to restock your shelves. But the wholesale market is chaotic. The refiners are raising prices. The Shanghai Magnet is sucking up inventory. What if by the time you go to restock tomorrow, the price is $85? You just sold your inventory at a loss relative to the replacement cost. You sold gold to buy lead. No business can survive that. So, what do dealers do in a vertical market? They widen the spreads. They jack up the premiums. Spot is $78.83. But if you go to a website right now, the price for an Eagle is likely $95 or higher. Or they simply pull the inventory out of stock. Call for pricing, that is code for we are not selling. They are freezing sales to protect themselves from the volatility. This creates a physical lockout. The screen says you can afford silver. The dealer says you can't have it. The real price, the price to get metal in your hand, is rapidly approaching $100. The paper market is lagging the physical reality by $20. Now we have to talk about the mining companies. This is the second half of the reality check. At $78 an ounce, primary silver miners are printing cash flow that rivals the tech giants. Their costs are fixed. They pay for diesel, labor, and steel. Those costs didn't go up 8% today, but their revenue did. That entire $6 move flows straight to the bottom line. However, look at the mining stocks. Are they up 8%? Some are, but many are lagging. Why? Because the general stock market is nervous. The war news from Venezuela spooked the S&P 500. So, generalist investors are selling everything, including miners. This creates a massive valuation gap. You have companies trading at 3 times earnings. You have companies with dividend yields that are about to explode. The market hasn't done the math yet. It hasn't realized that at $78, these aren't mining companies anymore. They are cash machines. This lag is the opportunity. Usually the metal moves first, then the stocks catch up. We are in the metal move phase. The stock catch-up phase usually happens a few days later when the analysts wake up and realize their price targets are obsolete. Let's check back in on our favorite indicator, Shanghai. We started this video by saying Shanghai was at $84. New York rallied to 78.83 to catch up. Did we catch them? No. We closed the gap from $10 to $5. but $5 is still a massive arbitrage. It means the sucking sound is still there. Metal is still flowing east. This tells us that $78 is not the top. If we were at the top, the price in New York would be higher than Shanghai. We would be overbought. But we are still underbought relative to the physical market in Asia. We are still the discount bin. As long as Shanghai leads, New York must follow. The dealers are freezing. The miners are printing cash. And China is still paying more. Where does this end? We are approaching the blue sky zone. Above $80, there is no chart history. There is no resistance. There is only the psychology of the crowd. We have analyzed the squeeze. We have exposed the shortage. Now we need a battle plan. Because information without action is useless. And in a market moving this fast, hesitation is the same thing as capitulation. Some of you are sitting there thinking, okay, but what if this is a false alarm? What if the mint opens tomorrow and the price drops back to $70? That is a fair question. Let me tell you how I am managing that risk and what my triggers are for the next 72 hours. First, I am not leveraged. I am not buying futures on margin. I am not selling naked puts. If I am wrong and the price drops, I lose on paper, but I don't get margin called. I can wait it out. The supply deficit is 300 million ounces. That math doesn't change just because the price dips. Time is on my side. Here are the specific indicators I'm watching. Number 1, the $91.50 level. If silver holds above 91.50 for 3 consecutive daily closes, I interpret that as a confirmed breakout. The technical picture flips from fragile rally to sustained launch. In that scenario, I am adding exposure. But I'm not buying physical at these crazy premiums. I'm not paying 50% over spot. I am buying the miners, specifically the junior miners. When physical silver is in backwardation and the miners are still trading at 3 times earnings, that is where the asymmetry lies. The miners give you leverage to the price without the gouging. Number 2, the margin hike. Expect the CME to raise margins this week. They will try to flush out the leverage. If they double the margin requirement and silver drops $20 overnight, do not panic. That is artificial selling. It is not real supply. It is just forced liquidation of paper contracts. If we get that dip, I am buying it aggressively. That is the moment everyone else runs for the exit and I am walking in through the back door. Number 3, the LBMA freeze. I am watching the London vaults like a hawk. If we hear official confirmation that London is switching to cash settlement, that is the end game. At that point, I am moving entirely to self-custody. I am pulling everything out of ETFs and unallocated accounts, because if London breaks, the paper price becomes monopoly money. Now let's talk about the trap of waiting. I know some of you are thinking, I will just wait for CNBC to confirm the squeeze. Do not do that. By the time Jim Cramer is talking about silver, the premiums will be triple spot, and delivery times will be 6 months. The mainstream media is designed to be late. You are here because you want the intel before it becomes consensus. And finally, let's talk about the exit strategy. When do we sell? The answer is not yet. We are nowhere near the mania phase. The public is barely awake. Your Uber driver isn't giving you silver tips yet. We are in the institutional accumulation phase. The big money is buying. The public is watching. The mania phase happens when the public goes all in. That is when we go from $80 to $150. You do not want to sell before the mania. You want to sell into the mania. And when you do sell, do not sell for dollars. Swap, trade one undervalued asset for another. Watch the gold to silver ratio. When it hits 30 or 20, that is your signal to swap some silver for gold or land. But right now, at 56, silver is still the best trade on the board. The ceiling is shattered. The sky is open. The US Mint has admitted defeat. Do not let them trick you into selling your life jackets just as the Titanic starts to tilt. Hold the line. We have looked at the math. We have looked at the mines. But there is one final layer to this story that makes it truly terrifying. Geopolitics. If you think the shutdown at the US Mint is just a glitch, you are missing the bigger picture. This is not a glitch. This is economic warfare. For decades, the West has enjoyed a privilege. We could print paper money and trade it for real resources from the rest of the world. We printed dollars and bought oil. We printed euros and bought silver. That era ended on January 1st. China is locking down its borders. Not for people, but for resources. They dominate the solar panel industry. They dominate the battery industry. They know that silver is the lifeblood of the 21st century economy. Do you really think they are going to keep shipping cheap silver to the West so we can build factories to compete with them? No, they are keeping it. This is called resource nationalism, and it is spreading like a virus. Look at Mexico. Look at Peru. Look at the BRICS nations. They control the mines. We control the printing presses. In a poker game between a man with gold and a man with a printer, the man with the gold wins every time eventually. The US Mint running out of silver is a symptom of a much deeper disease. It is a sign that the United States has lost control of its strategic supply chain. The Department of Defense needs silver for guidance systems for satellites for torpedoes. If they can't source it at the retail level, imagine the panic happening behind closed doors at the Pentagon. This is why the price creates a flaw here. We are moving from a globalized market where metal flows freely to a balkanized market where metal is hoarded by nations. In this new world, the COMEX price is irrelevant. The COMEX is a museum of a bygone era. The real price is whatever China says it is. And right now, China says it is higher. So, what is your move? The window is closing. I am not saying that to scare you. I am saying that as a statement of fact. Governments panic slowly, and then they panic all at once. When they realize the strategic stockpile is gone, they will ban the sale of bullion to the public. They will nationalize the inventory. They will implement capital controls. We are in the twilight zone. The sun has set on the old system, but the new system hasn't fully risen yet. In this darkness, you have a chance to act. You can still trade your dying currency for strategic assets. You can still become your own central bank. Do not look at $90 silver and think it is expensive. Relative to the money supply, it is cheap. Relative to its strategic importance, it is free. We are witnessing the revaluation of the entire periodic table. The US Mint going dark is the final warning bell. The exits are being sealed. The resource war has begun. Make sure you're on the right side of the fence when the gate closes. Get your metal, get it in your possession, and do not let go, because the next time the website goes down, it might never come back up. Class dismissed.